Talk about the markets and what it means for your money. Dhiraj, the managing partner and CIO at Roha Asset Managers, is with us on the show now. Dhiraj, morning, and thanks so much for joining in. Well, a lot of people we've been speaking to are saying that this is the time to increase the allocation to cash because it's so hard to call this market and which direction it's going to go. So forget getting into levels and 5% upside or downside or 10% as well. People just don't know which direction it's going to go. What's the call that you are taking at Roha Asset Managers now, and how are you deploying the money that you have?
Hi, good morning. I would like to start by stating that we are living in an extremely high volatile market environment. No doubt, and that should be treated as an opportunity for investors. Now, clearly, equity market volatility over the last few months has got exaggerated by weak global noise such as inflation scare, much rumored US recession, Europe energy crisis, and of late even extreme volatility in the currency markets. Now, the turmoil in Europe will continue, driven primarily by uncertainty on energy issues, while the US may not outperform the way it did in the past decade. Chinese economy is expected to grow at just over 3% this year, as per recent IMF forecast, due to its zero COVID policy and crackdown on excessive real estate lending. So what is left? So when we look at India, we continue to believe that domestic growth should withstand global concerns, and markets will brace this volatility or weak sentiments and eventually climb wall of worries despite currency depreciation. And there are plenty of reasons to briefly highlight. One is that there is broad-based earnings recovery. This will be led by private banks or financials, industrials and capital goods, and autos. The real estate cycle also remains robust with reduced unsold inventory levels, which is reflected in strong pre-sales and better cash flows. There is no material impact of even rate hikes on demand for home loans. Even in the first 5 months of current fiscal, home loan outstanding of banks has actually registered double-digit growth rate despite RBI raising interest rates. Second is, if you look at the consumption demand, it has exceeded even pre-COVID levels and one of the best in many years. Segments like travel, hotels, restaurants are doing brisk business activity. Consumption demand in apparel, appliances or white goods, footwear, jewelry sales are all witnessing massive recovery at the retail level. E-commerce firms alone have estimated to garner sales worth $12 billion during the 9-day Navaratri festive season that just got concluded. Even autos, whether it is two-wheelers, electric side, cars, commercial vehicles or tractor sales are all showing strong momentum. So barring cement and FMCG where margins can hit a bottom in second quarter, or the metal sector, most of the other sectors should report strong earnings growth. Besides, in our view at the macro level, inflation appears to be peaking out with broad softening of commodity prices, though Europe-led crisis is still creating some near-term shortage on energy-intensive commodity chemicals. Now, if you look at average prices of metals like aluminium, copper, steel, PVC and rubber prices have declined by anywhere 11 to 25%, though oil and gas and coal have actually sustained rising trend due to geopolitical issue. Now, another strong indicator of domestic growth is that the gross collection of direct taxes is up so far till the first week of October by almost 24% to almost 9 lakh crore, which is 52% of the budget estimates for the full year of tax collection target. And even GST collection is not showing any major let-up in demand and consumption. The other important notable sector that we all have to be cognizant of is the banking. It is reflecting an uptick in loans and advances with lower NPAs. There is increased momentum of new credit disbursements from both banks and NBFCs. And very importantly, lastly, corporate capex outlook is looking up after many years, driven by increased localization trends. Earnings of capital goods companies, in fact, are at cyclical lows, and we expect can improve significantly, as there are all indications of higher order backlogs. Capex cycle is actually picking up, driven by many segments like renewables, automation, even PLI schemes. Government's capex is actually accelerating in large infra projects like defense and railways, with thrust towards indigenization or localization procurement and modernization of works.
Dhiraj,
if I have to conclude lastly, just allow me to complete it. Net, it is good that we are currently passing through weak sentiments, largely driven by global issues, which means that the prospective returns in Indian markets are going to be much better. So stay invested and add more if individual money permits as a strategy.
All right, Dhiraj, you're sounding very optimistic that, India is still much better placed. And of course, that is a view that we have been getting in. Since you did mention the earnings and, we're right at the start of the Q2 earnings, what is the kind of earnings growth that you're looking at? And also, just on the IT space, of course, we had TCS yesterday, and we do have the rest of the bigger companies posting earnings this week. What do you factor in terms of IT? And do you think that there's risk of a much steeper fall from these levels as well?
So IT is just the preliminary, first result that has come out, and there has been modest constant currency revenue growth, besides margins headwinds. Now, deal pipeline, which was very robust a few quarters back, are likely to be muted, which is understandable. The other challenge IT sector currently faces is of attrition and higher salary costs. Certain segments of the market should exhibit weakness, including the financial services, which is a very large vertical for the IT sector in general, and non-essential even retailer vertical. So I think retail and financial services for the technology sector in India contributes almost 45 to 50% of the US demand or European demand. So hiring will likely slow down. Attrition rates, however, have peaked out in our view. But what is also coming as a small rescue is the rupee depreciation, which is depreciated by about 3.5 to 3.6% for the quarter, which is coming as a rescue. Now, valuation of large IT companies, despite correction, are not cheap, and one should only expect modest returns from here on. So we're looking at few mid-cap companies post-correction, as valuations have turned attractive in the mid-cap segment in technology.
Okay, hi Dhiraj. What are you making of this continuous selling by FIIs? DIIs are continuing to buy. Which one of them is getting it right?
Well, if we actually look at FI position, it is understandable that the global cues will obviously determine some of the ETF outflows. But when we actually look at it, we are unable to predict the direction for the rest of 2022. However, what is impressive is the rise in domestic equity culture, SIP flows into equity market, and DIIs will actually take a lead in the next phase of a bull market rally. And they've demonstrated strength to counter FI selling. So this growing equity culture in India is, to our mind, just the tip of the iceberg. It is just the beginning, versus the traditional forms of investments like fixed deposits or gold, which is no longer a preferred asset class. So this domestic investment itself will overtake or absorb FI outflow, if any. And our think is that I think FI flows are transitory. If India stands out within the emerging market in terms of relative growth and outlook, then FIs will do come back.
Dhiraj, thank you very much for joining in. Use this volatility as an opportunity to buy, and some of the mid-cap IT stocks, technology names are looking attractive.